Inflation just dropped, the US dollar is weakening, and, well, Bitcoin is surging.
Yeah, it's having quite the moment.
Right. By all traditional market logic, the entire crypto space should be, like, flying right now. So why is half the market completely frozen? Welcome to today's deep dive.
Glad to be here.
We are cracking open the Vantage Plus weekly crypto analysis for Monday, April 13th, 2026. And the mission for you today is figuring out this massive disconnect. Why institutional capital is flooding into the heavyweights while the altcoins are just left stranded at the dock.
Well, to understand that disconnect, we really have to look at the macro engine driving the market right now.
Okay, so like the broader risk sentiment.
Exactly. The overall risk sentiment is positive, mostly because the US CPI data came in slightly lower than expected.
You're right, up 0.9% overall, I think.
Yeah, and with core inflation at just 0.2%. So that weakens the US dollar, which makes dollar-denominated assets like crypto much more attractive. But, that optimism is hitting a hard ceiling.
Because the US-Iran peace talks stalled out?
Right, so we've got this geopolitical friction capping things.
It's almost like macro is the weather and crypto is just the thermometer, right? But what about that other massive risk factor the report mentions? The whole quantum computing thing?
Oh, yeah. That's a huge piece of this. For months, there's been this existential dread that quantum computers were just on the verge of cracking crypto security.
Yeah, which would be catastrophic.
Right.
But wait, does the lack of a sudden quantum crash actually matter for daily trading? Or is the CPI data the real driver here?
Well, it matters because it acts as a massive removal of tail risk. Researchers just confirmed that most major coins remain safe, while new, post-quantum cryptographic solutions are actively being built.
Oh, wow. So disaster averted.
Exactly. For institutional investors, the ones actually moving billions, taking a sudden catastrophic hack off the table makes them significantly more confident deploying capital right now.
Okay, but wait. If the existential threat is gone, inflation is dropping, and the dollar is cheap, mathematically, all dollar-denominated assets should be rising, right? The tide should lift all boats.
You'd think so, yeah.
So why are we only seeing Bitcoin and Ethereum absorb all this momentum?
Because capital rotation works like a waterfall, not a rising tide.
Ah, okay.
When big money enters a volatile environment, it parks in the safest assets first. So Bitcoin is currently trading at $71,510. It's sitting right below a major resistance zone at $75,000.
And if it breaks that $75,000 level?
If it breaks that, we aren't just looking at new buyers coming in. We're looking at a mechanical short squeeze.
Oh, so traders betting against Bitcoin get caught.
Right. They'll be forced to buy back their positions to cover their losses, which could literally slingshot the price toward $80,000.
And Ethereum is, I guess, benefiting from that exact same institutional safety play, right? It's at $2,212.
Yep. And crucially, trading above its 50 moving average.
But let me push back on that for a second. Is this upward movement genuine strength or just temporary relief from the weak dollar? Because, a moving average is just a lagging mathematical line on a chart. Why does that actually matter to the price?
Because of algorithmic trading.
Oh, the bots.
Exactly. That 50-period line is a psychological and mechanical floor where trading bots and institutional algorithms are basically programmed to automatically step in and buy.
So it provides a structural safety net.
Yeah, but Ethereum still have to punch through a massive wall of sellers waiting at $2,350. If buyers can't chew through those sell orders, the algorithms will just flip from buying to selling.
Yikes, risking a drop like we saw back in late January.
Exactly.
See, I have to challenge this whole narrative, though. If the tide is rising and the macro environment is supposedly so sunny, why are the Ripple and Solana boats still stuck in the mud?
No.
XRP is trapped under 1.3425, and Solana is lagging down at $84.12. That makes zero sense to me if the market is actually healthy.
It makes perfect sense when you look at the behavioral psychology of trapped buyers.
Trapped buyers?
Yeah. Take XRP. It printed a massive bearish candlestick on the monthly chart back in March. What that means, in reality, is that thousands of retail buyers bought the top and are now deeply underwater.
Oh, so every time XRP ticks up?
Those trapped buyers aggressively sell just to break even. Unless it drops, unless it holds the $1,300 support, we'll see a rapid slide down to $1,100 simply because buyers will step away and let the panic selling exhaust itself.
Ouch. And Solana is facing a similar structural nightmare, right? The report highlights it desperately needs to break $90, but what makes $90 the magic number where the trap springs?
We ought to break above $90. There's just no momentum to attract fresh capital. It becomes dead money trading sideways.
Just stuck.
Yeah. And if it drops below $78, it triggers an avalanche of automated stop-loss orders. People who bought the dip will automatically be sold out of their positions, which just accelerates the downward pressure.
So it's just a cascade of selling. Wow.
So as you look at your own charts this week, remember, we're dealing with a profoundly fractured market.
Definitely.
The heavyweights, Bitcoin and Ethereum, are absorbing all the macro liquidity because institutions are playing it safe. Meanwhile, altcoins like XRP and Solana are actively fighting their own trapped investors and heavy sell walls.
It is entirely a market of the haves and the have-nots.
Which leaves you with one major question to chew on. If the quantum computing threat isn't the existential threat we thought, and macro forces are heavily dictating every move the top coins make, what specific fundamental catalyst will it actually take to wake the altcoin market back up?